Today we will analyze why Apple is no longer a growth stock. Instead, Apple is more and more transforming into a stable, boring, quality stock. The Smarter series was delayed, car project Titan was cancelled, Apple Vision Pro's production was discontinued, and bugs over bugs kept the negative headlines flying in for Apple. And customers could get the feeling that Apple is the new Tesla, especially when it comes to announcing new features that will be pushed to later this fall. Headlines were bad, so bad that Apple's head of AI, John Giannandrea, lost Siri. And instead, Mike Rockwell, vice president in charge of the Vision Products Group, will now be in charge to fix Siri. Especially since its latest Siri failure, investors might ask themselves, where is all the growth optimism? What is the next big thing? Well, the future might be looking really uncertain, but if we ask if Apple is truly a slow grower, we think it is worth taking a look at three distinct topics facing the stock: confusing products, subscriptions, and high valuation. Then we might better understand how dire the company's future really is and why Apple might be a very bad growth stock, but instead a great quality stock. Back in the Steve Jobs era, this 2x2 chart showed how Apple wanted to focus and streamline the product lineup again. After nearly running bankrupt, they simply had products for the basic consumer, the Pro, and for each a portable and a desktop variant. Nowadays, they offer too many different products targeted for a wide variety of different consumers, prosumers, and professionals. The product lineup got so wide and unstructured that Apple pulled the plug by replacing 3 iPhones, the iPhone SE, 14 and 15, with just a single new one, the iPhone 16e. But this change made Apple's iPhone lineup even worse, since they currently sell an energy-efficient iPhone like the iPhone 16e using the custom C1 modem alongside the less battery-efficient iPhone 16. Worth noting that the iPhone 16e is cheaper than the regular 16. So consumers get confused, especially when the cheaper products like the 16e get more features like better battery performance than the more expensive iPhone 16. And then we had several software delays like a Smart Siri, which eventually comes in 2026. The lack of innovation coupled with non-fulfilled promises results in a toxic mix for a high-value tech stock. Now let's face the bright side of Apple's stock: subscriptions. At least for investors, the term returning revenue should ring bells in your head. As we analyzed in our latest video how important continuous cash flows are, especially for Wall Street, since it's a signal of reliance and stability. And yes, the services are where the growth optimism is coming from. Apple's second largest division after the iPhone has turned into a $100 billion a year business that Wall Street loves. That's the key reason for sticking with Apple stock, especially considering that Apple loyalty sits at 93% of surveyed customers, with Android lagging behind at only 80% loyalty rate. With a growth rate of 12%, the subscription sector seems to grow fast compared to the rest of Apple. Just for comparison, Google mother Alphabet grows by over 15%. Yet, here we are talking about all segments of Alphabet growing this fast. Apple's valuation was always above average, which is normal for an aggressive high-growth stock. As growth rates are slipping, its valuation with a forward PE ratio of 26 seems reasonable, but comes with a high risk regarding tariffs, since Apple's China-centric supply chain, once its great asset, is now a liability. Peers like Alphabet or Palantir also have high PE ratios, but grow considerably faster, meaning the investor gets rewarded for the high valuation. Palantir grows by 29% and comes with a forward PE ratio of 160, while the S&P 500 forward PE ratio is at 22. We see the Palantir's future earnings are taken into account, but keep in mind that the PE ratios can jump up if the tariffs lead to lower earnings. But what happens when investors lose the imagination of high growth rates coming in the near future? Considering all the recent market uncertainty, the stock is highly overvalued for what it offers and must either grow in earnings or decline in stock price. Even though Apple can be seen as Louis Vuitton or Ferrari in the tech sector due to its high margins driven by high loyalty rate among tech brands, we clearly see confusing products, lack of innovation, and delays, in contrast to a stable subscriptions and high retention rate. So Apple could no longer be seen as a growth stock. Instead, Apple would transform into a quality stock. An annual growth rate between 2 and 3 seems reasonable for a quality stock, while peers like Procter & Gamble have a PE ratio of 23 and a growth rate of 0.49%. Therefore, we see a clear buying opportunity, since this week Apple dropped below $170 and its PE ratio dropped below 24 as well. Especially as long-term investors, we might accept low growth rates for stable revenues backed by subscriptions and a very loyal customer base. Thanks for watching, and see you in the next one.